For our COBT listeners and viewers, it's Maynard and Mike here, Close of Business Tuesday, with what I have already predicted will be one of our best shows in a long, long time. Will Su is joining us. He's a managing director, head of public energy equities at BlackRock. He's got an extensive career in research, in investment, in commodities. He's a good friend of the firm. At one point, he worked with this guy named Arjun Murti. Will, we're delighted that you're joining and so excited to talk to you about what it's like to be an investor, particularly at a firm like yours in these kind of markets. We just cannot wait. So thank you for joining.
Thank you for having me, Maynard and Mike. Look forward to a great show.
All right. Well, I've stuck my neck out, Mike. I said this is going to be an awesome show.
It is.
What would you tell us about the markets today?
Well, as you most know, the markets over the next 24 hours are going to be pretty volatile, I would expect, right? Commodity and equity markets, because you've got a deadline tomorrow that Trump set out there. There's no peace plan or no peace meeting set up as of yet. I mean, maybe that happens in the minutes after we basically shoot this call, but we don't have anything there yet. And so what we've seen is, sort of crude oil, WTI, over the last couple days is up about $9 from Friday's close, right? $92. You remember last week on Friday, we went, we closed down $10 or $12 to like $85, $86 a barrel. So we're up from there right now, because as we're approaching this deadline, as there doesn't look like there's any movement right now, markets are starting to get a little concerned and dialing some risk in. It really is interesting is when we think about the equity markets as well. Equity markets are pretty much near all-time highs. And I think the equity markets have dialed in that, okay, there's going to be a peace plan. We're going to open the Strait of Hormuz very quickly, and that's why oil has come down. That's why equity markets are hitting all-time highs. The thing that worries me is what if we don't? Okay, the market has gone 30 days ago from technically oversold to now it's technically overbought. It's dialing in a lot of good news, and if we do not get good news here in the next 24 hours, the markets are going to be coming off. And so that's a concern. The second concern I have is let's assume that we do have the Strait open up. We do have a peace plan. I think that is probably going to be net negative for oil, net positive for markets, but a lot of that's dialed in. I don't think what people are thinking about is what are the residual effects going to be about on markets, not tomorrow, next week, or, a month down the road, but what is Q2 earnings going to look like? What are Q3 earnings going to look like? What is going to be the residual effects from supply chain issues there, from inflation? I don't think that's dialed into markets yet. We're going to start getting industrial companies reporting here in the next week, 2 weeks. You're probably going to hear some color from these guys on that. And so that's going to be a little concerning, we'll see what they have to say. As far as the energy sector, today it's all about oil service earnings. Halliburton reported their Q1 results today. Pretty good results. The thing I took away from that call is that North American activity, and we've been talking about this for the last couple of weeks, is we think North American activity is going to surprise to the upside. They pretty much said that. They said that we're in the early innings of things getting better here. The white space that they saw for basically Q2 and the second half is essentially gone away now. And so, what this says is E&P companies are thinking that oil prices are going to be a little higher than they were, obviously, 30, 60, 90 days ago. The question is, where are they going to settle out? Are they going to settle back in the low 60s or the low 70s? We think it's going to be low 70s and mid 70s is where we're going to fall out. That is the go signal for some companies. Guys that we're talking about yellow light scenarios are probably going to green light scenarios. And like I would say, it's not going to be robust. It's going to be moderately increases. And you're going to see that mostly in mid, small cap names. You're going to see that with private names. So Halliburton validated it. We're going to see some Weatherford and Schlumberger and Baker talk about this later this week. So hopefully we'll hear some follow through. So that's kind of the market that we see at this point, Rainer.
Well, Will, it is really so fun to get to talk to you. I know in our world, really since the Iran thing started, every day is just full of, is it a volatile day? Is it a day when things look bad, or is it a day when things look better? And you've just had this roller coaster. Of course, it's very serious stuff, and So I don't mean to make light of it at all, but it is definitely a roller coaster. How do you manage it as an investor? You're watching all these holdings, they're moving around a lot. You're trying to deliver long-term returns. Like, how do you manage the volatility in a world like the one we're living in?
Yeah, I mean, great kickoff question. I would just kind of say three things, right? Number one, very fortunate to be in a position where the degree of navigating through the chaos is by looking at tickers on the screen, analyzing from the safety of a desk in a safe country in a city. We have colleagues that are based in Abu Dhabi and in Dubai that are living through unimaginable chaos and disruption to their everyday lives today. I think that's a much more difficult situation to navigate. I think number two is teamwork, which is these very colleagues, along with the many other commodity experts, geopolitical experts, folks who are in the administration, who have served in the military within the firm today, are collectively discussing these things every day, right? So when I wake up in the middle of the night to check some of these messages, the chat's already lighting off with what is the newest game theory between the negotiating parties, what's the newest damage assessments. So having that big team and that network of BlackRock and a large institution behind me is a really kind of empowering thing to get a better understanding of every aspect of the conflict. And then the third, I think, that we tend to fall back to is we do have, I think, the luxury and the responsibility of being long-term investors, right? So we're stewards for investors' capital. None of the capital is ours. We're investing on behalf of people who need multi-year, multi-decade outcomes on their capital. And that allows you in times like these to, not lose sight of what's happening on a day-to-day basis, because sometimes years happen in a week in the markets. And I think this is certainly one of these times. But over time, over the 6, 7 weeks that the conflict's been going on, I do think that some longer term patterns are emerging. And I think we're in the business of making bets and making investments on things that are becoming more and more likely over time. So what are some of these things, right? These things are the inevitable reality that oil flows have been disrupted. A lot of energy flows and commodity flows have been disrupted. So the true kind of black swan, right? The mother of all black swans has happened in the oil markets. I remember reading my good friend Paul Chang's kind of oil choke point report back in like the mid 2000s, right, where we outlined the 10 biggest choke points. And I don't think anyone's ever really thought the situation would actually transpire. And here we are several weeks in with no solutions. What's definitely going to happen is a lot of the flows won't restore themselves quickly, right? I do think a lot of unprocessed crude oil has the ability to bounce back relatively quickly once the seaborne logistics are solved. But as you guys have discussed on this show many times, there's long-lasting impact when it comes to restarting LNG terminals. There's a lot of above-ground infrastructure that's been destroyed, whether it's Qatar Gas or the various refineries. And these are things that will take years to rebuild in normal times. But one of the things that I think people take for granted is that they are supplied by the very same supply chains that AI data centers and high performance computing data centers are using. Some of the turbines that are going into these LNG trains or GTL upgraders are going to be coming from the Honeywells and the same suppliers that are supplying, these AI data centers, right? And there's a 4, 5, 6 year backlog to a lot of that equipment. So in a way, you can almost see the future to a degree, regardless of the pace and the outcome of these near-term negotiations. And it's a increasingly dicey situation to get through. So these are some of the things that we're watching and looking and thinking, well, where are the companies that are well positioned to benefit from that?
So, and that was fascinating. Will this is the way the market has seemed. This is just me. You and Mike would describe it much better and more thoughtfully, but it seems like it overreacts to anything short term. Like whatever's on the screen, it overreacts. Like Trump says blank, it's way up, way down. It's very volatile. But it has a fundamentally overly positive tone to it over time. Like last week, when we did the show on Tuesday, Mike said, I think you said the S&P was within, you know, it was very close to its all-time high. And it's just this, we've talked about two disconnects around here. One is the disconnect between the financial and the physical markets in oil. But the other is the disconnect between the oil world and the rest of the markets, which seem pretty healthy. So I think there's a question in there somewhere, Will. I'm asking, do you perceive the market as like fundamentally positive with periods of overreaction, or how do you think about the nature of this market?
Yeah, I do think the broader US equity market is a very strange beast. And it's one where a lot of the old timers are not used to because the composition of the market is so different than it used to be, right? I'm sure everyone's seen concentration stats on how big the Max 7 is as a percent of the S&P. I remember Neil's episode on COB Tuesday where he talked about energy being only 3% of the S&P. I do think, hey, look, if you zoom out a little bit and you look at the ACWI All World Equity Index, energy is a larger percentage, right? It's in the low fours. And if you look at the world's equity market excluding energy, it's closer to 5 for energy as percent of total equity. So I do think there's something more skewed about the US, and that has to do with our leadership in AI and the fundamentals that are coming in. And by the way, these AI companies are not expensive in a lot of the conventional sense, right? Because their earnings power is so high. I think the debate is over the sustainability of that earnings and how long that can last. But I think, to your original question, a lot of the observations that I have is, well, you could argue that there is a two-track economy today. There's an AI economy, and that includes everything in its way, whether it's the software layer led by the Anthropics and the OpenAIs, or the hardware layer for these memory, right? It started with GPUs, then it moved to memory, and now it's moving into cable and optics and all the things to enable these things. And they are creating in themselves a lot of concentration and skew within different markets, right? Look at South Korea. Two stocks in the South Korean index is 45% of the entire index. So if we thought that the S&P was concentrated, take a look at that one. And by the way, they're two of the three major producers of DRAM memory, which is critical for the AI build-out. But I think if we had a morning discussion here this morning, and our analyst in India was just talking about some of the underground impact in India, and it's a real struggle for a lot of people, right? You're talking about not being able to cook because LPG prices are too high or the canisters are not available. So again, I think there is a deep underlying economic impact from what's happening. I think we're a bit segregated from it sitting here in Houston or in New York because what shale and the shale revolution has enabled is to have really significantly shielded us from the worst of the inflationary impact that could come from something like this. We'll still feel it. It's still going to show up in the data and the numbers and the consumer sentiment down the road, but we're a lot better positioned for it, right? And then number two is just locationally speaking, we're not directly in the way of the oil flowing out the way that in India or Pakistan or other Asian economies are.
So one thing that's been on the radar, again, people's lives are in jeopardy. So this is really serious stuff. But financially, one of the things that's been on the radar has been the potential for recession. Whether that's however defined global recession or really devastating, real slowdown in global growth. Do you think that's the right model to think about, which is, hey, if all these strains keep lasting, you will have global recession? Or is the right way to think about it, if all these strains keep happening, some areas will be hit, but other areas are going to do fine. And you just need to, and so you really shouldn't oversimplify and say we'll have a global recession. Like, how do you think about the impacts of this?
Yeah, I think the latter is a more fitting framework for it, and it has something to do with the two-track economy that we talked about earlier. But look at the simple facts, right? There's enormous AI investment happening in 24. That flows directly into GDP via the I function. In 2025, people doubted that it would grow. It doubled. In 2026, people doubted it would grow. It's going to go up. In 2027, it's going to go up. So these numbers are fundamentally there. They're being founded by very well-capitalized organizations, and they will have positive impacts down the line, right? There's going to be benefits from industrial companies, from power companies, from a lot of energy companies in this build out. And that will be, in many ways, very resilient versus the more OPEX driven part of the economy that are impacted by oil, by LNG, by power prices. So I do think there's going to be a bit of a two-track dichotomy there. But I do think at the end of the day, I agree with you 100%, which is it feels overall like the market is very nonchalant over the disruptions being more extended, right? If I look at December 27 TI and Brent, they're kind of sitting at 70, 75, which I agree with you is kind of a good Goldilocks zone to invest. You earn very attractive returns for a lot of the tier one, tier two companies that are able to produce at that level. But the risk there, I think, is probably skewed to the upside, right? If you don't resolve these things in the coming few weeks and months, this becomes something more serious that can only be resolved through demand destruction, and there's nowhere else can we find the supply.
So, Will, do you replay the tape? Because I'll confess, I've done this a little bit. You replay the tape, and if you go back to when we first started, the military action against Iran, and at that time, it seems like, the world, particularly the U.S., we'd gotten used to these small military actions that are, where the world quickly goes back to normal. And it just, at that time, I don't know what would have been on everybody's radar, but if you replay it, it sort of seems like, wow, when you start doing what we started doing, oil, worst case scenario, might drift back, to something where like you had this strange setup, which looked like at worst oil might stay the same. And then you had varying degrees of which oil might really run in terms of how big the price run up was. Is that how you guys were thinking about it? Or how, when Iran hit, was your perspective different on what was going to play out than where it is now?
Yeah, so in my past life, I was a commodity trader, and I think a lot of my work would have been around, well, how high does the deferreds go? How far, how deep can the backwardation get, right? And then what's the physical DFL, CFD kind of spreads that I can kind of play to figure out where front month futures will be trading at. I think again, as a long only equity investor, a lot of the work kind of comes down at the end of the day to look, something has fundamentally changed. What is the impact that I can put a multiple on, right? So then we're talking about capitalized earnings power and sustainable earnings power, in addition to obviously, what some would call windfall earnings for the coming few quarters. And the perspective there was ultimately oil prices would settle to a point where supply demand balance, right? And I think that's not a very smart statement to say, but it's just always what happens, because the beauty of commodities is that it'll find a way to rebalance supply and demand. And I think a lot of that thinking has changed after the day where Iran really did a number of infrastructure damage in the region, right? So the day where Qatar Gas 4 and 6 were taken offline, Pearl GTL, and then the follow-up attacks that took out a lot of refineries. So that was something that, in my mind, has put in a completely different outcome in terms of the capitalizable earnings power down the road.
Can I just ask you something on that, Mike? You got to jump in next. It seemed like, because as you mentioned, you have all those geopolitical experts around BlackRock. You have people in the region. The company has a ton of visibility and knowledge. That point where the Iranians started striking, quote, their friends and hitting energy infrastructure, and then pretty quickly it became basically this is how they're going to shut the Strait of Hormuz. Did that surprise the tactical, military, geopolitical experts around BlackRock? Well, I'm just curious. I mean, that was an effective thing for them to do, but what was the conversation like around that?
It's such an interesting question because I think it was split neatly into two camps. There were people that were predicting that this would never happen because it is such a obvious red line. And there were another group of, very smart, intelligent people who I think in hindsight were 100% right in saying that this is a fight for the regime's survival, that the response would be painful enough to force a negotiated outcome, and to deter further military action in the country. And I think that's basically what played out, right? And again, my very loose observation is folks who have spent time in the region, who have spent time studying Iran's history and their response function from past conflicts, were the ones that were more likely to draw the ultimately correct conclusion, that regional infrastructure, including some allies, would be within the range of fire because that's the most effective strategy.
Hey, Will, thanks for joining us for sure. I mean, what's interesting to me is I think that about the last 5 years in managing money, my gosh, how difficult that must be. You know, you've had basically energy transition type investments. You've had COVID. Now you had the straits close. It just seems like all these issues are just hitting one after another, to be quite honest with you. And so that must be difficult to manage money. I guess my question is just when you think about what's happened here today, and I don't even want to talk about what happens if China goes after Taiwan, what that means to world markets, but when you think about the fallout from what's going on right now, I heard Halliburton on their call today talk about energy security is going to be a bigger deal for most people. That's why spending is going to be higher overseas, more countries. I mean, what do you think the fallout is, say over the next 2 or 3 years, just from macro type themes, be it North America, Europe, Asia?
Yeah, so I'm hosting our firm-wide call this week, and the question I posed was basically along the same lines of, look, we've been discussing Iran nonstop for the last 6, 7 weeks, but the question is really, how does this change the way that you run risk or the way that you manage the tail risks, right? Because again, it's not every day that a large tail risk becomes a reality that you have to live with, and one where you still don't have any visibility on the outcome and the conclusions. Look, I mean, I think we picked this business and this career in a way because we're a little bit masochistic and we enjoy the intellectual stimulus from learning in periods of uncertainty. And again, there is no certainty. There's only varying degrees of risk. And now is probably one of these times where the risks are very elevated and the dispersion of the outcomes are very, very high. So a few things that we're doing, right? We're doing a very whole portfolio approach. So, have equities behave the way that they should, have fixed income behave the way that they should. Well, through the conflict, again, so far, having it been unresolved, equities have outperformed fixed income, right? And that is a shocking outcome where equities are now several percentage points before the close, above the close from February 27, and 10-year yields are still more than 30 bips above. Not the usual kind of risk behavior that you would expect. You also have interesting outcomes in terms of the hedging instruments, right? Where gold, which has outperformed a lot coming into this conflict, ended up suffering a drawdown, at one point a rather large drawdown, and crypto or Bitcoins, which has done poorly into this conflict, has actually been one of the best performing asset classes, right? So again, very difficult to explain these shorter term movements. What happened with gold was actually pretty classic in that it should be the instrument of safety, but there was a demand for US dollars when a lot of the trade has frozen up. So some of the larger central banks, especially in the emerging markets, ended up selling it as the kind of asset of last resort to extract liquidity, right? So there's all of these kind of back and forth and circular logic that happens in the market that's very hard to resolve in the very near term. Again, I think in the long term, it seems like one of the consensus points based on the response to the question of the week from this week is that people are rethinking a bit about tail risk in the portfolio. And for the energy industry, which is one that's been overlooked for a long time, where, like many people have said, has shrunken to 2-3% of major index weights, there is starting to be a view that this is something that will have a bigger role. This is something that's a diversifying effect on my portfolio that I've been underweight to for the last decade. And then also to tie this into the other big theme that people are obviously still talking about, which is AI, right? AI has steamrolled the software as a service sector, because everything that's producing this amazing cash flow with high organic growth has all of a sudden been called into a terminal value question. And all the hard assets, right? Metals, energy, oil, natural gas, fertilizers are just 100% not AI disruptible, right? So now there's an emerging theme as well of, well, there's a hard asset class that the world will depend on. AI doesn't accelerate the energy transition. It probably actually increases the intensity of the energy addition. So not only is this not an AI loser, it's a big AI winner. So these are some of the changes that are happening, but I do think it's really reinforcing a fundamental rethink of how people have constructed their portfolios, how they view things in terms of how they perform in periods of risk on and risk off, because a lot of the old rules have been thrown out of the window.
Can I ask you, will it change? You mentioned, changing thinking about risk. Does it change perhaps how you manage the portfolio? And I'll just ask a dumb question. My impression of big institutional asset management is, people are in charge of flavors and they become experts in those flavors, and then they allocate capital within the flavors, and the people who put the money in know that, okay, it's in that flavor. But as you're pointing out, one of BlackRock's great advantages is you have all those people sharing knowledge and comparing and debating. And maybe you would be particularly good. I'm thinking about just some of the themes here, from AI through to mining or hard assets. Maybe there's a portfolio that should be constructed that has kind of a little bit of each flavor. That's a buffet of that whole supply chain, and maybe that would be a more desirable thing to hold than a flavor. But how do you think about your portfolio and an investor's portfolio in this world that stretches from the exotic to the classic?
I think what you've described is effectively how a lot of institutional asset management has already decisively gone down as a path, right? So we have a whole portfolio approach for our clients, which means we tailor the risk and return characteristics depending on different people's situations and financial states and needs. And that requires inputs from different parts of the firm, right? So we have fundamental fixed income, fundamental equities. We have systematic equities that behave differently in different market conditions. And I think for my neck of the woods, right, where we have to be alpha generative stock pickers and select positive alpha, alpha will always be in demand, because that is a difficult skill set, something that's difficult to compartmentalize. But if we can provide that alpha for our clients, and the portfolio overall can be constructed with the right risk reward characteristics on top of the beta, and we layer in that alpha, that's an attractive proposition to folks. The overall composition is also something that's being discussed, right? Where the 60-40 portfolio has worked for a very long time, and we're starting to advocate that in certain situations, a 60-20-20 portfolio might make more sense, where you take some of that fixed income allocation and put it into alternatives. So things like infrastructure, where you're getting above market yields with the potential for some participation to the upside, could be an interesting new asset to add to that basket. But I think that's been a conversation that we have had as a firm with clients for many, many years coming into today. It doesn't replace the need for active investment and management. In fact, it probably magnifies it, because at the end of the day, I can deliver beta to clients cheaply and effectively. It is the alpha I have to rely on actual operators, actual people who go on a rig, right, who go and tour Guyana and really understand the fundamentals to then add to that return in a way that doesn't change the overall risk reward characteristic of that portfolio. So it's really an all of the above menu, as you put it.
I almost feel guilty asking this because it's so obvious and it's becoming the question. But in your own business, in your own trying to understand things, trying to allocate capital, trying to keep up with companies and stocks, are you finding AI to be a tremendous unlocker of value for you? Like, how is it changing your day?
On a scale of 1 to 10, I think it's a 20. And I'll explain why, right? I think AI, first of all, is one of these really tricky concepts. It's a very revolutionary technology. It is also one where if you're a white collar worker like myself, you definitely feel a bit of that existential threat, right? Because it is surprisingly good at doing some of the things that you thought only you would be good at doing. Um, so I think it's people have a love-hate relationship with AI. Some of my observations on AI is that it's advancing very, very quickly. Um, a lot of times when you talk to people about AI and they say, well, it couldn't do 5 plus 4 correctly, so I don't trust anything that it says. They might be using kind of 5.1 ChatGPT when the more kind of cutting edge people are using Opus 4.7, and then some of the special select groups are now testing, the new Mythos models, right? And each generation is quite a bit more intelligent than the prior. I think the other is people think, a lot of people still think of AI as a Q&A kind of chatbot, right? What's the best Chinese food within 5 miles of where I live? But the real power of the AI has actually been unlocked by a lot of the kind of co-work, open claw type of integrations into the computer, right? So over the weekend, I was just coding up a database for myself, and it was basically able to write something like 2,000 lines of code within kind of a few hours. And now it's running a whole database for me. It's sending me 20 emails every single morning summarizing the news that I care about, the company development sourced from different things. So it's very good at doing things that used to take people a lot of investment. People might have been intimidated because they didn't have a degree on computer science. I had a minor in it, but I'm very bad at it. So I effectively had no degree in it. But it's really an enabler for you to do so much more than ask it questions. You can use it to automate parts of your life. You can use it to automate parts of your research. And obviously, on an enterprise scale, it provides a lot more. I think the third thing to be aware of on AI, for what I do in equity research, is that it creates a greater risk of groupthink, and it creates greater crowding risk. And I think having the ability to both use AI effectively, but also having an AI BS detector that's always turned on is going to be an increasingly valuable skill. You want to use it to make your life more efficient. You want to use it to expand the scope and quality of your research, but you got to know when it's giving you kind of a groupthink type of message that makes it just fundamentally difficult to apply in the markets, right? Because the markets are a zero-sum game when it comes to stock picking and alpha. So having that detector up is going to be pretty important.
That last point is fascinating. Do you think that will show up? Like you mentioned, you're a long-term investor. If AI contributes to herd mentality, and Trump says something, market goes down 10% because the herd mentality has been accelerated. Like, as AI accentuates the herding of our thinking, will it accrue to the long-term investor who can see through it and knowing what we're doing?
100%. And, where I think it really comes through is people with deep knowledge of their industry and experience in that industry, right? Because again, if you look at the creation of data, something like 99% of data was created in the last 2-3 years, right? So that's what the AI is trained on. It's very hard to train on when you or Arjun were looking at the industry 20 years ago. It doesn't exist.
Right.
So when you see patterns and similarities to that period of time, the machine doesn't. And if you're convicted that that is something that's going to replay, or you see the rhyme in that pattern, I think that's something that's going to differentiate a lot of what you see versus what the AI sees.
Can you think, this is an unfair question, but I'm just curious, can you think of an insight that you got much quicker because of AI that you either wouldn't have gotten, or it would have just taken a lot longer to get, like in your own business? Has there been a recent experience where you said, wow, if it hadn't been for AI, I would not have possibly realized that, whatever it is?
Yeah, I probably have a few. I mean, one that is relevant to oil and gas is just thinking about, look, natural gas in the US has been in a 2-decade bear market. right? And I think people generally give it a reputation of, well, you give us $4 gas and we're going to add 100 rigs and all of a sudden the rally's over. I think having some of the AI going in to dig through state level filings, just publicly available things that were just historically difficult to wrangle together, and using it to piece things together really gives you an edge on, well, there's different ways for this industry to now monetize, right? First of all, much more consolidated industry. Top five now controls almost 20% of production. But more importantly, the AI helps you stitch together this view of, look at the amount of demand that's coming in the PJM, right? Look at the early kind of signs that there might be this 10 gigawatt plan that the Japanese are now going to build in Ohio. Look at the plans of expansion from the AWSs of the world, the other hyperscalers of the world in the region. And then finally, think about all the ways that the producer can potentially negotiate a longer term supply deal that doesn't impact the market in the way that it used to, because the supply's been kind of matched one for one with demand. So that's not the most intuitive line of thinking that you would have had kind of 2-3 years ago when AI was emerging. But that's almost exactly what's playing out today, and benefiting a lot of the producers up in the Northeast. And what I think for me, it would have been hard for me to put all the pieces together without help of the deep research, the kind of unconventional research that it's able to do, because not every sell side firm is writing about it.
Will, we're talking about so much, you mentioned the 10 gigawatt power plant in Japan or in Ohio by the Japanese, but just project after project, there's so many proposed things right now. Do you think, how do you think about, are we going to finally get some permitting reform? Are we finally going to get all this infrastructure built? Like, how do you think about that logjam and the pace of all this? Because I notice sometimes in our own system, somebody occasionally says, yeah, power demand is not going to grow like that because we're just not going to be able to build all this stuff. Like, I'm just curious how you think about the reality check on all this spin that is supposedly going to happen.
Yeah, I think it's hard to take the numbers at face value, right? So something like 200 gigs of data centers have been proposed since ChatGPT 4 has been announced, and I don't think we're building 200 gigs of data centers in the US. I do think something like a quarter of it could get built by the end of this decade, right? That's a realistic number, and that is a number where if you start to add together the grid expansions, the regulated utility expansions, as well as obviously increasingly the bring your own generation behind the meter deals that are being signed, it is a number that I think is within reason in the next 4 to 5 years, right? It's a very large number, but it's realistic. I think people tend to discount things that are very large because they haven't seen it before. And we've certainly not seen growth like this in such a short period of time before. So the usual arguments that I hear are, well, this is all for training. Once you train the models, the inference will fall off and the demand wouldn't be there anymore. Or the various kind of, this company CDS is trading at 900 bips. So that means that the money is not real. Well, I think on the latter, you've already seen, again, a lot of the very well capitalized hyperscalers stepping in, a lot of them within the last month, to back these multi-gigawatt projects, right? And you have seen a lot of the neo clouds benefit as a result of that. So the demand is real, it's continuing to grow, and it's coming. And I think to the first question of where the demand is going, the inference demand is real, right? Because again, we're not just asking it for where the Chinese restaurant is. We're asking it to do very complex things. I did part of my taxes using Claude Cowork because it was able to do some of the more routine things for me in a very automated way. And I promise you that the amount of power it took to do that is 100 to 1,000 times what it would be to just get a text query back, right? A lot of these things are going to be used in the future for, I would say, fairly zero-sum games, right? So algorithmic trading. If I deploy a gigawatt to trade, someone else is probably going to also deploy 1.1 gigawatts to trade against me, and it becomes a little bit of this arms race of demand. Same can be said about kind of optimizing ads that you see on TikTok or on other social media. So there's just going to be a lot of demand. And it really does go back to the whole Jevons paradox of if you build it, it'll come, it'll create its own demand over time. I deeply believe that that's the direction that we're going in. And again, tying that back to our industry, we're not doing any of that without energy security, right? Not to meet just the data center side, but to keep everything else that's also growing running. Petrochemical exports are disrupted out of the Gulf. We got to do more of that, right? We got to supply more fertilizers. This North American complex is the only place that can give you that surety of supply in addition to the AI demand that's coming. So that's what makes me really optimistic for the amount of building and growth that we have ahead for this industry.
Yeah, totally agree with you, Will. I guess maybe this is an overgeneralization, but it feels like the conversation is always the US and China trying to dominate AI, right? And it seems like the rest of Asia and Europe and South, whatever, they all get lost, and it's like they're not even involved in this race. And I guess number one, is that true? But number two, when you think about, your portfolio, about your, over the next 10 years, how you're going to invest, how does like who's investing in AI, what countries are investing in AI, really kind of make you start to think of, what, those are going to be the winners, those are going to be the losers. We got to manage our portfolio, not only by, source sectors, but by, first by countries based on this. I mean, is that into your thinking at all? Is that a big deal?
I think it's a very important deal, and it's a very great observation, right? Again, not to pick on them, but the number one AI model that is created in Europe now ranks, I believe, number 74 on a test that standardizes all LLMs, right? The US just clutters the top 10. We have, I think, 8 of the top 10 spots, and the remainder are coming out of a number of Chinese AI labs. So it's a two-person race between China and the US. The US has a dominant advantage in that we're way ahead on all of these benchmarks. At the same time, you might have seen this, there's a lot of diffusion of the training, right? Where we spend multiple billions of dollars training, then the model gets kind of distilled into pieces and it gets reverse engineered into some of the catch-up models coming out of Asia. So it's a little bit, a little bit of a writing or piggybacking off of the activity that we're doing. I think, again, taking that longer term lens and looking forward, we have a big technology advantage. I think we arguably have a type of energy advantage, but China at the same time has many energy advantages compared to us as well, right? They're building a new hydroelectricity dam that is, something like 3% of the country's demand, the biggest one ever built in history. Obviously coal still dominates the Chinese power generation stack at more than 70%, but without some of the constraints that you would have in the US, there are advantages to scaling power. And ultimately, I still stand by this quote that I used in my podcast a few months ago, and I think it was Secretary Burgum that said it in Abu Dhabi, right? He said, ever since the beginning of human history, knowledge is power, but for the first time, power is knowledge, but for the first time, knowledge is power and power is knowledge, right? So you have this interesting setup here where it's kind of our race to lose if we don't get things like permitting done, if we don't get things like grid optimization or ensuring power supply done correctly, because we have the lead. And it will be a shame to squander that lead, because this is a lead that will define how the world behaves in the coming decades, right? So I think it really is a call to action to kind of make sure that we have not just the production part, not just the energy distribution part, but every part of that supply chain to make sure that we remain in the lead, we deploy these systems, and we basically use it to help everyone's lives become better and more efficient. And then we can get into the questions of national security and the many, many other downstream implications from this amazing technology.
So I was thinking, Will, Mike referenced you got to BlackRock in 2018, so you've seen 8 years of so many variables from COVID to the transition to Ukraine to where we are now with Iran and AI. My question for you is, it seems like the base case model people have of the US is we're increasingly relying on natural gas. We're going to find a way to bring solar and batteries into the mix where we can. We might build a new coal plant or two here or there, and we're trying really hard to get nuclear back in the game. I mean, that's just a rough, kind of scorecard I think a lot of people have. Is there a different and then the last one is that we have a really great supply of natural gas, but our oil, could plateau, maybe in the next 5 or 10 years, or there's this maturing shale oil thing. Is there a different scenario where, because this is so important, AI is so important, all this growth is going to happen, all this national security stuff matters so much, where, in 5 or 10 years, oil production is up dramatically because we've just really leaned into it. And we haven't built just a couple of coal plants, we built 20. And, and is there a version of all this? And maybe this is why you're saying you're so excited, because there's an upside case here around all this that maybe we're underestimating how much we'll do. But I'm just curious what you think about that.
I think there's clearly upside to North American and US production volumes, right? Because again, if we think about the conversation of all the things that's been destroyed as a result of this conflict, the LNG plants, the fertilizer plants, folks forget that the UAE is building some pretty large compute clusters for AI, which now might be downsized as a result of some of these conflicts. Again, that compute doesn't wait for people to come back to the table, right? So it migrates to a place like the US where they have the Stargate project, where they have ownership in Golden Pass, and that's where you'll kind of get a lot of that uplift. So I certainly think that there is upside there. I do also think that, look, the energy industry has come through this cycle, right, of enormous production growth that then resulted in a pretty long and painful period of lower prices and consolidation. And obviously, the investor community has asked them to be very capital disciplined, return on and off capital. I do think the dial will shift a bit towards return on capital instead of return of capital in the coming years, right? Because there should be many, many return-rich opportunities to come. And I don't think investors are so prescriptive that they would say, hey, forget about this completely new set of great opportunities to invest, to get contracted cash flows or to get cash flows that are fairly high confidence. Just give me back my money. I don't think that's a message that most investors are sending to companies. At the same time, it's kind of like once the black swan happens, then it's just a gray swan, right? So you've seen this happen before. I think the management teams who have steered their companies through to be the companies that they are today have all seen how the last episode has played out. I think by definition, on the margin, they're just going to be a bit more cautious and require a bit of a higher hurdle to make these investments. So I kind of pick somewhere in the middle, where I do think if you look at just today's consensus for where volumes are going, I think we're going higher because I think the world needs it. And I think this land is just blessed with the resource to provide it, and it will be produced at the right price. I do think the pacing of that and the magnitude of it will be probably a little bit more rationed and a little bit more stepwise incremental than what we have seen back in kind of 2011 to 2014 or 2016 to 2018. It's a little bit different of a ball game.
Do you think Canada? We talk a lot about Canada and what it was, what it became, and what it could be again. How do you think about all that resource potential in Canada and the U.S.-Canada relationship? Do you see a change coming? Are you optimistic around all that?
Big optimist on Canada. I think the administration has shifted to one that's much more pragmatic on all matters energy. I think you have done a lot of the heavy lift, right, in terms of putting in things like phase one of LNG Canada, right? You put in a lot of these high capex projects from which you can then deliver incremental returns on capital that are much more attractive going forward, right? Some of the most difficult first pipelines that had to be laid from Alberta over to the Pacific have been laid. So going forward, the expansions should be an easier lift than they were in the past. And then on the relationship, look, I would just say that there is perhaps no two countries more intertwined in terms of their energy systems than the US and Canada, right? It's a very long shared border. There's parts of Canada and parts of the US that are just existentially relying on imports or refined products from, either in the US from Canada or vice versa. We've been neighbors for a long time, been allies for a long time. There's obviously some strings in that relationship today. But again, this is a win-win situation in terms of the energy system, right? The two countries can work together to supply the rest of the world. I think we're truly partners in many ways rather than adversaries. And again, you're just deeply endowed with resources, both up in the western part of Canada as well as throughout the continental United States. So I think it'll be a very symbiotic relationship in the years to come, but very constructive on some of the developments in Canada as well.
This model we have of we have all this unrest. We all think national security concerns are going up. We all think supply chain mentality is just increasing. All this stuff, and it makes sense. But is there another scenario out there? I mean, I'm sure there's some chance, but like, is it possible? Is it on your radar that like the Iran thing concludes well? I don't know what that means, but it somehow means that Iran is defanged, that the gray swan is now even gone, and maybe even Iran opens up to investment. The UAE says it is absolutely not getting hit now because it's a different, like, is there a peace settlement in the Mideast that, not that we would change all that mentality around national security, but do you have an upside case in all this?
The answer is yes, because I've traded oil and invested in energy for long enough to know that anything is possible in the sector. So I think, my kind of mental roadmap throughout this entire conflict is the Strait was going to reopen one way or another at some point in the future because the world necessitates it. Now, whether you open it through what you can, I guess, call a US victory versus an Iranian victory is up for debate, right? So there's different conditions and different ways that the oil can flow. What I do generally think, though, is that even in that best case scenario, there are a few risks that are inevitable that you have to recognize, right? One is you open the can of worms to potential military action and damages to invaluable physical infrastructure in the Gulf. So once these things happen, it's very hard to put that back, to put the genie back into the bottle. People now know that there is some element of risk to operating and producing in the region, right? That's number one. I think number two is there has been real damage that you can't turn the tap on tomorrow, right? I think my rough survey is something like $60 billion of infrastructure has been damaged. More than 80 assets have been hit. Some 2 million barrels of oil capacity has been impacted. 3 to 4% of global LNG through the two trains on the Qatar gas. You've also impacted the future growth of LNG from the future phases that were slated to come on in the coming years. 20 to 30% of global fertilizer flows, right? So a lot of these things will be reverberating for a long time before we can kind of declare victory. And then on the LNG point, right, even if the fighting ended tomorrow and the entire single blockade, double blockade, whatever it is, gets lifted, I don't think we're restoring full production until kind of an August, September timeframe, right? These are fragile, complex industrial cities that need to be restarted. And by the way, as you get closer to that October, November timeframe, you're starting to enter the time for Asian winter, where LNG demand will spike, and it will become kind of a bidding situation between the Asian market and the European market. So there is a clock on even the positive outcome to happen in terms of preventing a much worse economic outcome, especially for some of the Asian economies, right? So the short answer is yes, you can get the resolution. I think I'm an optimist, and I definitely hope that that's a situation that we arrive at. But I think the delta decay to a worse outcome is also increasing by the day.
Yeah, well, I kind of started my investment career at Enron and basically was during the whole gas and power convergence, right? And when I see what's going on now, it feels like the lines between electricity and energy, they're being used interchanged, they're interchanged. And I guess my question to you is the lines being blurred between fossil fuels, electricity? How do you see this market sort of developing over the next 5 years? Not from an M&A or anything, but just are we seeing the lines blur, and what does that mean for multiple stuff of that nature?
Yeah, I don't think the lines are blurring, but I think the partnership is becoming better defined, right? So I do remember several years ago when it would be much more contentious to support one or the other. And I think we've all grown up from that stage, and we've gotten to a point where we recognize, again, all of the above. It's an energy addition first and foremost. And then on top of that, it's a really clear partnership between, especially on the power side, gas and renewables, and increasingly it's looking like gas and nuclear and battery backed solar, right? So you have multiple things that serve different purposes. We obviously have solar, where the cost is continuing to come down, where the battery energy storage systems are helping you kind of fill in more of the gap throughout the day. But as we know, even the best system there is not truly 24/7, 365 dispatchable. So you need natural gas. Then you look at natural gas, right? Combined cycles, we built them for a long time. We know how to build it. They're already fairly efficient, very ecologically friendly when compared to some of the other alternatives. And then there's also different ways to which you actually might not have to build as many new natural gas plants, but end up utilizing the plants a lot more, right? That deals with some of the things like resolving grid congestion, some of the points that John Arnold has repeatedly raised to his credit, and I think he's absolutely right. There's different ways to run the system better that we just haven't for the last 2 decades because electricity demand was flat. But when you go from flat to 2-3% growth, I think a lot of smart people are going to be putting a lot more work to figuring out how do we use the system more intelligently. And if I look forward into the future, I think it's a system where we have more gas, more solar, more batteries, more wind, although at a slower growth rate when compared with solar. And then we're going to figure out very smart ways to kind of turn on the plants when they're available, turn them off when they're not economic. And then the end result should be a lot more power availability and relatively lower price per unit of power, right? That should be the common goal, whether you're in the oil and gas industry or in the renewable industry or in government on the state, local, or federal level. That's the outcome, because we've seen over and over again, and Arjun's done awesome work on this, energy is wealth, and energy progress is economic progress, is social progress, is human progress. So that's the ultimate goal that we're going towards. And I'm very confident that we are already well on the way with a lot more good stuff to come in that direction.
Well, Will, this has been awesome. You're increasing my reputation as a forecaster, because I said this was going to be a great show, and gosh darn it, it was. So I got it right. But in all seriousness, we really appreciate the time and you letting us just range across so many of these topics. It's fascinating. We really appreciate it.
Thank you guys for having me. This is a great discussion. Look forward to more episodes and seeing the conversation continue in the industry. Thank you.
Come on down to Houston. You know, Mike and I are in our Veriton vests. We're gonna have to send you a Veriton vest, Will, or some other bling. We'd be honored.
Size medium, send it over. I'd be proud to wear it.
Okay. Thanks, Will, and thanks everybody.